Hello, everyone. Thank you very much, NinjaTrader, for hosting this webinar, and thanks everyone tuning in for your time. Hopefully this can be both fun and educational, and we can move ahead with gamma capture. So what is gamma capture? That is what I'll get to in a moment. Just a little bit of background about myself. I've been a commodity broker for many years. I've traded options and futures for myself. I've brokered options and futures for other institutional customers. So, fairly well-versed in the trading arena. Then not too long ago, a few years ago, these zero DTE options, the short-term zero-day options in the S&P 500 started getting very popular. And they were kind of a fun little side kind of punt to do in my personal account. And I, along with one of my colleagues, were having fun trading zero DTE options, and we were realizing that there was not a great way to measure intraday volatility. It's notoriously difficult. Intraday volatility is tricky to measure. It doesn't really fall very, cleanly into the standard deviation of log returns model. And so we came up with gamma capture. So let me move forward the slides. So this is me, Louis Pellathy. That's my LinkedIn. I'm working together with Casey Hackett at Lehigh and Caleb Johnson at Lehigh. Our website's gammacapture.com. And again, thank you again, NinjaTrader, for hosting this webinar. So let's start with, statistics 101. If you remember back in your statistics class in college, or if you've taken one, the way Bollinger Bands are measured and the way most people measure volatility is using this formula. It's a standard deviation of log returns. So here you see the formula, standard deviation, the sum of squares of the difference between the current log returns and the average. So RI's returns observed in one period, and the R average is the average of the log returns. So log returns, again, going back, kind of refocusing here on, a very statistical measure out of textbooks, which is the standard deviation. And N is the number of returns in a data set. So again, you can measure returns using a couple of different methods. There's a close method, there's Parkinson's. There's other ways that people measure this return price, but at the end of the day, it's plugged into a standard deviation formula, and then what pops out is a volatility number. If you're looking at minute data, you can extrapolate into an annualized number by, multiplying by an annualization factor. So this is how Bollinger Bands work. They take a standard deviation and they move it one or two standard deviations up from a moving average, one or two standard deviations down from a moving average. And lo and behold, you have Bollinger Bands, again, based on this measure of standard deviation. And we'll get to the fun part in a second. I just want to make sure everyone's kind of thinking about standard deviation. It's not something that really comes up very often in conversation, if you're in daily conversation, but this is the measure for standard deviation. And what we have created is a measure called gamma capture, which is superior to the standard deviation formula. I'll show that in a minute. So our formula will eventually replace Bollinger Bands or anything using standard deviation model. Why is the standard deviation not necessarily the best way to measure volatility? It's because the numerator can get very high if there's jumps. So think about it daily. If you trade intraday prices, no matter what stock, futures, ETF, there's always going to be a lot of jumps, especially if you go down to tick data or second data. You go down to very low increments of time. There's always going to be a few jumps. Those jumps will skew the results of your standard deviation. And you get something like this with your Bollinger Bands. The blue lines are the Bollinger Bands. So on a big down move here, for example, this is the S&P, the D's contract of the S&P 500. There was a big move down at 4 o'clock. Bollinger Bands widen out very quickly. Why is that? Because this is considered a jump, whether up or down, it's a jump. And these bands widen out because it's taking into account this data. And as this data rolls off the rolling look back window, the bands narrow very quickly as well. So the Bollinger Bands, and again, really an idea for the time. And when things weren't as volatile, worked perfectly. It's just we're in a completely different environment. You know, we're in an algo-driven environment, and jumps are very commonplace. So that was the motivation behind creating a new statistical measure that displaces or replaces this formula, and that measure is called gamma capture. Again, I'm going to still stay focused on standard deviation because I want to really hammer home the benefits of gamma capture over standard deviation. That's, you know, our competitor, so to speak. You know, that's where we're trying to move beyond the standard deviation model and say gamma capture is empirically better. So in that vein, I'm going to keep talking about standard deviation for a little bit longer. I don't know if you guys can see this website here. This is the gamma capture website. You're able to see that okay? Here you have an instance where the Bollinger Bands widen out very quickly. The price moves down very, fast as a jump, and the bands widen out. The reasons why the standard deviation of log returns does not work is the following. We're assuming that there's a normal probability distribution of returns, which is clearly not. In times of jumps, there's a lot of outliers. So that the standard deviation fails on that. It's actually very sensitive to outliers. Standard deviation is highly sensitive to outliers. A single large positive or negative value can disproportionately influence the standard deviation, making it less reliable. And if anyone has ever used Bollinger Bands in the past, you'll know that that is the case. They widen out very quickly and they narrow very quickly, making them kind of not such a good volatility measure. There's no distinguishing between upside and downside and volatility clustering. So again, this is your typical move of the Bollinger Band when the prices move. It widens very fast, and thereby rendering it kind of, useless in some ways. So, but I'm hoping everyone's kind of like jogged their memory back into statistics. So let's get into what gamma capture is and how it works. This is the formula for gamma capture. Take an up-down barrier width. We take an up-down barrier width, and we see how many times that barrier is crossed over a 60-minute period. And the number of crossings in 60 minutes divided by 60 gives you an average crossing per minute. For example, if you're looking at an hour look back window and this isn't a realized volatility, right? This is realized volatility. So you're looking backwards. It's not implied, it's realized. If you look back 60 minutes and you take a barrier of 0.25%, for example, up and down from the current stock price, and as the stock crosses it up to upside, you count those crossings, and it counts the crossings on the downside, and you total the number of up and down crossings. Let's say it's 120 crossings in an hour, divided by 60 is an average of 2 per minute. Let's say there was 180 crossings in an hour, that's an average of 3 per minute. So you can see that this numerator never explodes, so to speak. Even with outliers, the outliers just add more counts, but it doesn't destabilize the measure. And that's the beauty or the benefit of gamma capture is that we're using a completely different measure for calculating volatility. Again, this measure will break down in it jumps because you're squaring the difference, right? You're summing the squares. And only then do you take the square root. So an outlier will make this standard deviation number very big very quickly, and it will render your Bollinger Bands useless. Our Bollinger Bands, or what we like to call gamma capture bands, which are the new Bollinger Bands, and that is the title of this webinar, these will be the new Bollinger Bands in the marketplace. We're working with NinjaTrader and other big platform vendors, and this is the cutting edge volatility. This will replace Bollinger Bands very shortly. So hopefully you guys can get on board sooner and use it for a little bit and test it out yourselves. Here is gamma capture again laid over Bollinger Bands. So what happened during this big price downward move? Bollinger Bands widen out very fast, whereas our yellow gamma capture bands, you can see, stay very, very stable. This can lead to very nice buy and sell signals. Here, where the price went up, this might be considered a sell signal, crossing the band here. Here, where the price went down, you might consider this a buy signal, and so on and so forth. These might not yield you any signals, where Bollinger Bands are going to give you what I call false signals. You might be buying and selling very quickly or not at all, depending on how wide and narrow these get. But our yellow gamma capture bands stay very stable over the course of any asset class, no matter the volatility, using tick data, using second data. And the reason is, again, we're not using this formula. We just count the number of times that a barrier is crossed. And the interesting part about that is that ties that directly back to trading P&L. If you think of these barriers as limit orders, sell limit and buy limit, as your buy and sell limits get crossed, you're trading the market, so to speak, and that the number of trades that you achieve over a 60-minute period is what you would you can convert that back into a volatility, to a gamma capture volatility. Whereas that's why I call this a trader's volatility. Standard deviation is a textbook volatility. It was designed to fit a certain perfect world that really doesn't exist. And again, the net result is that you can track volatility very nicely and cleanly and accurately throughout the day. You can use gamma capture to create bands, up, down, barrier, crossing bands. And more interesting, or as interesting, you can plug the volatility number. It's an annualized volatility number, just like any other, back into a straddle market, a put and a call, an at the money put and a call. Now we can come up with straddle break-even bands based on our volatility measure. And what's a straddle? A straddle is a combination of an at the money put and an at the money call. A market maker might sell you a straddle. You might buy a straddle as a retail trader and say, okay, I want to own, quote, volatility for the day. I think things are going to move a lot. So you buy the straddle. These gray lines represent the straddle premium at 10 a.m. in the morning. So let's say you want to trade a 0-day option, or you just want to trade the futures. This is what I consider a daily move breakout, whereas the previous chart is intraday. You can see more intraday volatility when you do the bands. When you do the straddles, you see the daily move. So let's say you log on in the morning, you want to buy an at the money 0-day option, whether it's S&P, this is on S&P, or other underlying assets. And this is your P&L where you make money if the asset goes outside of your straddle market. So this straddle, this top gray line, is a put and call premium added together. This is a put and call premium added together minus where the current value of the S&P was. Gives you the gives you the down band, and the up band is just plus the at the money premium, at the money straddle premium. And if the market should break out of these bands, you will make money as an options trader, or just as an underlying futures trader or stock trader. You can clearly see that there was a downward trend that broke through where the straddle would tell you is a break-even price. These are marked throughout the day. So you can see if you bought a straddle at 11 a.m. or at noon, the bands get narrower. There's a time component to options where they're worth less as time goes on. Therefore, the bands get narrower. And again, this price action clearly broke through these straddles, lower the put side of the straddle. So this might be considered a bearish move. I mean, if I'm trading and I'm looking at this pattern just as an intraday trader, it's breaking through the puts. I think there's a downward trend to the market just based off of the fact that it broke through here. Some might take the opposite view and buy, but these are definitely indicators that are very useful. Not very well not very well utilized because again, a straddle, to calculate a straddle premium, you need a volatility. And that volatility is, we use gamma capture for our volatility. And so therefore we can create straddle break-even moves. Again, this is just going through the rest of the slides. It's gamma capture, and it helps determine intraday volatility. We also are going to come out with volatility term structure. What does that mean? That means that currently we're looking at a 60-minute look-back window for gathering our data, but then we can look at 120 minutes, 180, 240, so on and so forth, plot those points and say, okay, this is what volatility term structure looks like intraday. Then we can use our gamma capture to come up with at the money straddles, our bands, and again, our volatility monitor, which just helps to spend a little bit of time back onto this one. This is this purple line here represents a realized volatility of the past 30 trading days, and this yellow line is our gamma capture. So this is our intraday volatility. So here you can see that the volatility is in line with a 30-day, and then as the day goes on from 10:30 to 11:45, volatility is less than our 30-day. That might give you an idea, oh, should I buy an option here? Because volatility is a little lower than our 30-day. Or conversely, you could, using it as a order management, you could say, oh, the market's less volatile. Maybe I should move my bids up to the market. Where here, when things are more volatile, I can leave bids resting below the market and still get filled. So you can use volatility as a order management tool as well. Okay, so this is really the verbalization of those price graphs. Okay, it has always been true that there's complexity in calculating intraday volatility, and that makes zero-day options difficult to evaluate. So I'm not sure how many of you guys joining here are options traders, but in order to come up with a reasonable theoretical value for a zero-day option, you need a zero-day volatility, or at least a very short-term volatility. So you could take our gamma capture volatility, plug it into a Black-Scholes model, and come up with a theoretical options price that you can then go back and compare to what's out there in the marketplace. So this is a highly useful tool for zero-day options traders. We have the visualizations on NinjaTrader. You can trade on volatility levels. Then you'll now know it's just an extra set of data points that you now know where volatility is, as opposed to just prices. And we use a 60-minute look back as our standard look back window, meaning because we're realized volatility, you need some past history of data, spanning a certain length of time. Our length of time is 1 hour. So we have a 1 hour look back window. We look at the number of ticks. We look at tick data or second data, and the number of times an up-down barrier is crossed can be backed into a volatility number. Zero-day options, as you might know, have really increased in volume. You can see here that the retail trading, this is a rolling 5-day average of retail trading volumes in the first part of the year. Just the retail portion of it just keeps getting higher and higher. And again, this volatility measure can be used to evaluate these zero-day options. I trade zero-day options myself. They're a lot of fun. And without this tool, it's very difficult to say whether or not what you're buying on the screen is a fair market price, right? There's nothing to compare against. You just see bids and offers, and you just take a position and say, I'm bullish, I'm going to buy a call. And you don't know whether or not you should be paying $1.20 or $1.50 for that call. You just, close your eyes and buy. Well, gamma capture will give you that clarity to say whether or not you bought, relatively close to market value, if you use it as the input into the Black-Scholes. So again, zero-day options are very popular. The most popular one is this. It's the ETF, the SPY, and anyhow, the advanced trading technology, the rise of retail platforms, and growing interest level in short-term volatility. In order to trade zero-day options, a intraday volatility is necessary. It's a necessary component. In order to trade futures, I also believe an intraday volatility is necessary if you're doing intraday trading. So I think gamma capture can suit the needs of both futures, stocks, and options traders and ETF traders alike. Again, these are for future releases. We're going to do a bid-ask volatility instead of just a single line. And here, this is our volatility cone, which you can see the term structure of volatility within certain look-back windows, anywhere from 30, 15 minutes, 30, 45, 60, out to 240 minutes. This won't be in the first release of our indicator, but this is going to be in the later release. And that's all I have for the moment. And I'll leave it on this slide right here because this is the formula for gamma capture. And I just want everyone to be somewhat familiar with it because it's very clean. It's very easy to implement, so to speak. I'm a little bit of an exaggeration. It's not that easy to implement, but it's a very clean formula. And the reason the formula is here is because I don't think it's a good idea to keep this as a black box and you don't know how this volatility is calculated or what the methodology is. This is really just a methodology statement here. But what you're doing is you're picking a certain width from the current value of the stock. You want to say my width of my up-down barrier is 1/4% higher than this current value of the stock or 1/4% lower. And I'm going to move my barrier along. Every time I cross the upside, my barriers will then reset. So there's a new barrier. And if I cross again, the barriers will reset to be on either side of the current stock price. And as the numbers of crossings increase, you're increasing your count. And then in a 1 hour window, you say, okay, how many times have I crossed in a 1 hour window? You divide 1 hour by 60 minutes to get a per minute crossing, multiply that back to the up-down barrier width, and you get a gamma, and you get a volatility. It's very clean and it's very hopefully understandable and relatable, and hopefully I've made the case that it is a better measure than what's currently being used. So with that said, that would be the end of the slideshow presentation portion of what I have, and I'm happy to stick around for any questions. But thank you again for showing up, and this will be available at the end of October as a purchasable indicator. You can find us at gammacapture.com. But what I'm really trying to impart is that we are the premier intraday volatility measure, and we will be displacing your Bollinger Bands in short order. So that's really the message today, is that this measure is its time has passed. It's time to move to a better mousetrap, so to speak, or a newer technology, a newer way to look at volatility. So thank you guys very much.